DocuSign is a nearly $40 billion e-signature business that has been doubling in size every 2 years. But despite this massive growth, it has a relatively lower stock price than some other common companies I discuss on this channel, including Cloudflare and Datadog. So in this video, I'm going to be going over DocuSign's background as a company, reviewing their most recent earnings report, and talk about what these numbers mean for the future of DocuSign. And as always, stick around till the end of the video to see whether or not I personally made any changes in my DocuSign investments. So let's dive right in by first looking at how DocuSign got to where it is today. First off, what does DocuSign even do? Well, DocuSign allows people to sign documents online without needing to have a physical copy of the document in front of them. Basically, it's an e-signature company. They have been around for quite a while. In fact, they were founded way back in 2003 with an initial focus on finishing real estate transactions entirely digitally. Since then, they have continued to grow in large part by signing on partnerships with other large companies including Google, Salesforce, and PayPal, allowing users to complete transactions with these different companies using online services. Throughout the 2000s, they continued to grow at an extremely rapid pace, and by 2012, Bloomberg reported that 90% of the Fortune 500 used DocuSign. They finally IPO'd in April of 2018 at a price of $29 a share, putting their value at $4.41 billion. But the stock price quickly rose from there until it settled in around the $40 to $50 range. For comparison, as I'm filming this video, the stock is currently off its all-time high at a price of $210. DocuSign continued to expand to different industries throughout the 2000s, using both their brand recognition as well as several patents on digital web signatures, eventually becoming the dominant player in their market. From 2017 to 2019, DocuSign grew at a rock-solid pace of between 35% and 40% every single year like clockwork. And that growth continued into the beginning of 2020, until the e-signature market effectively blew up. As I've talked about before on this channel, March 2020 marked not only the beginning of working from home, but also the beginning of one of the most explosive periods of growth for any companies that made remote working easier. This caused companies like DocuSign to effectively experience 2 to 3 years worth of growth all in the span of a couple months, making their stock price immediately surge upward. And we can see this clearly by looking at DocuSign's growth numbers both before and after the start of March 2020. In 2017, DocuSign grew 35.93%. In 2018, 35.19%. In 2019, it increased to 38.95%, but that still falls far short of the growth rates that they reached in 2020. In the first 3 quarters of 2020, so those are all the quarters leading up to the most recent earnings that I'm going to talk about in a second, they grew 39%, then 45%, then 53% in each of those quarters. And that's where they left off as of the end of last October. But now we have the final results for the final quarter in 2020. And while you might expect that most of the growth from the first 3 quarters would have already captured all the new available customers for DocuSign, based on these more recent earnings numbers, it looks like they still might have quite a bit of runway to go. DocuSign grew 56.75% in their most recent quarter, which on its surface looks like an acceleration from the 53% growth that they saw last quarter. But that's only when you look at the year-over-year comparison, and year-over-year can be slightly misleading, especially when they had a lot of growth earlier on in the year. Because DocuSign signed subscriptions with their customers, if they grew their revenue the previous quarter, that growth is essentially included in the year-over-year comparison for the next quarter, which can make the numbers look artificially large. If we instead look at their sequential growth, so how much they grew from last quarter to this quarter, they grew 12% in terms of their revenue, which is actually a slight deceleration from the around 15% growth that they saw last quarter. If we were to annualize this 12% growth rate over 4 quarters, it would come out to a growth rate of 57% for the year. Now, this is probably higher growth than we're actually going to see over the next 12 months, especially based on the guidance that leadership issued, which we'll talk about a little bit more later. But the point is, the revenue growth for this quarter really doesn't leave anything to be desired. They grew their total number of customers to 892,000, an increase of 52% year over year. They grew their commercial and enterprise customers even more, up 67% year over year to a total of 125,000 customers. Management noted on the earnings call that their rate of customer growth doubled this year, and that the number of customers they added in the past year was almost as high as the number of customers they added over the entire first 15 years of the company's lifespan. Talk about exponential growth. They grew their earnings per share to 37 cents this quarter, for a total of 90 cents over the entire year. That's up from 31 cents for the entire year of 2019. Looking at their international growth, the numbers are even better, with them growing 83% in terms of their revenue to a total of $287 million in revenue from international customers. That means that they now make around 29% of their overall revenue revenue from international markets. They've also increased their dollar-based net retention rate for the 4th consecutive quarter to now up to 123%. They've also continued to improve their net margin every quarter. Over the past 4 quarters, they've grown from 8% to 10% to 12% to 18% in the most recent quarter. This in turn can be seen in their gross profit, which went from 37% in the first quarter of the year to 60% in this most recent quarter. This puts their total gross profit for the year at $1.15 billion. So you might ask then, why did the stock price drop after earnings? Well, I think there are 2 possible explanations. The first major cause of the price drop, in my opinion, is a sector rotation away from tech stocks. In my last portfolio review, I looked through all the different companies that I hold in my stock portfolio, and I noticed that the majority of them were all down by exactly 30%. I kind of doubted that all of those individual companies were suddenly worth 30% less than they had been a few days before, so I figured this large drop was caused by larger investors either just selling these securities or moving that money from these securities to somewhere else in the market, possibly worried about these companies losing customers once remote working ends. I think this is extremely short-sighted because just looking at DocuSign's numbers, their customers love them. Their customers on average spend 23 additional cents for every $1 they spent last year, showing that once customers start using their product, they just want to use more and more. While I could see DocuSign's growth potentially slowing in 2021, I absolutely do not think that they're going to decrease their total number of customers. Which brings me to the second reason this stock may have dropped. Leadership's earnings forecast. DocuSign's CEO has said in the past that he expects their future revenue growth to be higher than it was pre-2020, but not as high as it was during the height of remote working. Their guidance for revenue next year is 36 to 37%, but based on their billings, I think that's a very likely underestimate of what they're actually going to show next year. Billings growth in general is a front runner of their revenue growth. So if we see a growth in billings this quarter, we're likely going to see increased revenue at some point in the future. In their most recent quarter, DocuSign saw their billings grow 21% sequentially from one quarter to the next, giving them a total growth rate in this area of 56% for the year. Now, they had only guided to 31% growth in their billings last year, so this was clearly a beat. And next year, they're similarly guiding to a 32% growth rate in their billings. Now, I don't think they're going to grow 56% again next year, but I think it's very likely that they're going to beat by some amount. Let's say they had an even more modest beat and only made 40% growth next year. That would still be in line with what the CEO has said about growing faster than pre-2020 but slower than during 2020. Additionally, because billings is a front-running indicator of revenue growth, that 21% sequential billings growth we saw will likely appear in higher revenue in the future. This makes it more likely that their revenues growth will outpace their billings growth for the year. So let's say there's a billings beat and they get to 40% growth next year. It would be very reasonable then to see the revenue growth as high as 45%. Now sure, that's not the 60% growth that they saw in 2020, but that's still a really high growth rate, especially considering how much of a bigger company DocuSign is now than it was a year ago. The fact that the company keeps getting larger and larger, and yet they're still able to grow at the same percentage every single year is extremely impressive. So aside from likely beating their revenue estimates next year, what's next for DocuSign? Well, DocuSign sees a lot of potential in what they call the agreement cloud, which basically includes everything from preparing agreements to signing agreements to managing them to acting on them. And they put the total addressable market for this at $50 billion. They know that they're already number one in the e-signature market, but DocuSign is starting to view this as just the trigger for a much larger potential transformation, one which will make them dominant in the entire life cycle of agreement management in the cloud. One of the things I like about this value prospect is the fact that it ties their future to this general shift to the cloud and to companies like Salesforce, Google, and Amazon, companies that are pushing customers to move into the cloud so that those customers will need some kind of cloud solution for their agreements. Because DocuSign already has pre-built integrations onto all of these platforms, it makes it so much easier for customers that are moving into the cloud to use DocuSign's platform as well. What's the point in going through the effort to start using Salesforce to manage all your customer relationships when you still sign all the documents by hand instead of using DocuSign integrated onto their platform? What's the point in migrating all of your on-premise applications to Amazon when you're still going to have people manually sign forms and then send pictures of these to the cloud? Why not just do the signing natively in the cloud using DocuSign? DocuSign includes this chart in their investor presentation, which shows their current $1 billion slice of what they see as a potential $50 billion market. Now, the skeptical side of me says that DocuSign is just pushing this larger vision of the agreement cloud because they know they're a one-product company. They are really good at that one product, but you can't keep growing at 50% when you're already a dominant player in the e-signature market forever. But then again, this does show that they are being proactive in addressing this potential problem, which could stunt their future growth. So the key to all of this then will be DocuSign launching new successful products which appeal to their customers just as much as their e-signature product has in the past. Two of these products are already available: their Contract Lifecycle Management, or CLM, and their Insight/Analyzer platform. They also have a third product, Notary, but that's still in development. The CLM product will be used to generate agreements, track them, make sure that everybody has all their approvals in the right place, and will just generally act as the backbone for DocuSign's larger mission of controlling the agreement space. Next up, we have Insights, which DocuSign says will use AI to pull out certain clauses and agreements from a contract. Now, to be totally honest, I'm not really sure why this would be all that useful, so if anybody has a better understanding of why you would want to use this functionality, please let me know in the comments. Finally, you have the Notary product, which will basically allow you to video conference in a notary and then sign all your documents electronically without having to physically go to a notary's office, saving you both time from traveling and money. Of these products, to me, Notary seems like it will be clearly the most obvious winner. It fits really well with DocuSign's existing e-sign platform, and it seems like an obvious add-on. That being said, the Notary market is likely much smaller than the market for CLM or for analytics. So the Notary really may just be more of a nice bonus, but the bulk of that $50 billion total addressable market is going to need to go to the CLM and Insights and Analyzer platform. So I told you at the beginning of the video that I'd let you know if I personally made any trades in DocuSign, and I did. I actually added 50% to my overall DocuSign position in my Charles Schwab account, and then also any money that I've been getting in M1 Finance when people sign up and get 10 free dollars when they deposit $100 has also been going toward DocuSign. So let me know what you think of DocuSign, if you agree or if you have a different take. A good, healthy dialogue is always appreciated. With that said, if you enjoyed this video, make sure to hit the like button and subscribe, and I'll see you next time.